Welcome back, everybody, to Volatility Trading Strategies. So coming off the heels of my last video where I was talking about the delisting of a couple volatility ETPs, TVIX and ZIV, rest in peace to both of them, today is the opposite. Today I'm going to introduce a new player to the volatility space. The official name is the LHA, which stands for Little Harbor Advisors, the LHA Market State Alpha Seeker ETF with a ticker symbol MSVX. It officially launched on May 13, 2020, so about 6 weeks ago, and it currently has assets of about 32 million, so a pretty solid start for this new ETF. Now, we can't put this thing in the same category as the other more well-known volatility ETPs like VXX and UVXY. I'll get into why that is in a few minutes. But this new Alpha Seeker ETF does have a volatility component to it, which is why it is getting an introduction here. So I'll go over its market bias, we'll take a deep dive into its performance, and I'll highlight a few of the market periods where this thing is designed to do a little better than the broad market, to see if it's doing its job. Now, for us at VTS, we trade several independent, rules-based tactical rotation strategies and then combine them into a diversified portfolio. I launched over 8.5 years ago, and in that time, we've crushed all our benchmarks. But most importantly, we've done it with very low drawdowns along the way. So the big question for me is, can this new MSVX actually play a role in any of our strategies going forward? Does it fit in with my overall investing philosophy? Now, I do want to make this very clear. I have no affiliation with this new ETF. Nobody asked me to do this video, I'm not getting paid for it, and I will receive no benefit at all if any of you out there actually go out and buy it. I'm not plugging it here. This is just an introduction to my own community of a new volatility product because my work over the last 15 years has been very volatility specific. So subscribe to the channel if you haven't already, and go ahead and smash that like button to let the YouTube algorithm know that you appreciate volatility related content. And with that, let's talk about MSVX. So I mentioned that we can't put this thing in the same category as the other well-known volatility ETPs. This thing is not like VXX, UVXY, or SVXY. And the reason is simple. This thing is entirely discretionary, whereas those other products, they derive their price entirely based on the VIX futures. Of all the things we're going to talk about today, that's probably the most important thing to keep in mind. We won't ever be able to accurately predict its forward performance because its holdings and its market bias are entirely at the discretion of the fund managers, which means they may nail it in certain market environments and they may miss the mark in others. Discretionary trading is like that. There is a level of inconsistency to it. But that doesn't mean that it doesn't have any structure. This thing does have stated goals. I briefly spoke to Matt Thompson on Twitter just to get some clarification on a few things. He's one of the advisors at Thompson Capital, which does manage the foundational Alpha Seeker strategy that this new ETF is based on. You can get all the nitty-gritty details you need in the prospectus, which I will link in the description below if you want to read it. But in a nutshell, MSVX is heavily influenced by the VIX futures term structure. In times of contango, they target long SPX and short volatility. And in times of backwardation, they target short SPX and long volatility. Now, if you're not familiar with those terms, I'll do a brief overview now for you. But of course, you can check out all of my other videos because we do talk about the VIX futures term structure and all the volatility metrics quite a bit here. This here is an example of the VIX futures term structure in what we call contango. You can see this anytime at VIXCentral.com. Now, this is from March 2017, a year which saw very low volatility and stable markets. All of these dots represent a monthly expiration cycle, and as you can see, each further out month is priced higher than the previous month. This upward sloping curve is what we call contango, and this condition is typically present during stable markets. So whenever conditions are similar to this, the bias of MSVX will be long the broad market and short volatility. Now, in contrast, this is the VIX futures term structure from March 2020, an obvious period of elevated volatility as this was right in the heart of the global pandemic. And aside from an odd little bump there in the curve around the US election later this year, you can see each monthly contract is priced lower than the previous one. This downward sloping curve is what we call backwardation. And under these conditions, the MSVX is targeting short S&P 500 and long volatility, trying to capitalize on uncertainty in the market. So we know what this thing is based on. It is heavily influenced by that VIX futures term structure, and I would imagine they use several other volatility metrics as well. But now let's dive into the performance and see how it's doing versus its benchmark, which is the S&P 500. Now again, in my quick conversation with Matt Thompson, I got clarification on how they'd like to see the results from October 2011 normalized. The reason we have to do this is there was about a 50% exposure shift at the end of 2014. So in order to have an apples-to-apples comparison with its benchmark S&P 500, we need to reduce the MSVX performance from those first 3 years only, just common sizing. And when we do that, here's what we end up with. Now this is going back 105 months of trading, nearly 9 years now. And obviously during that time period, we've seen several significant market declines. 2015, 2018 had a couple, and of course recently in early 2020. We've got a pretty good sample size of market conditions here, and at least on first glance, it does appear to have underperformed its benchmark a little bit in the last 9 years. Like I said, I have no skin in the game here with this fund, so whether it goes on to be very successful, or maybe just doesn't gain any traction, it really makes no difference to me, so I'm just going to be as objective as I can with this analysis. Typically, when people look at performance, the first thing they look at is that absolute return number, the annualized rate of return, otherwise known as compound annual growth rate. So looking at that as the headline number first, there's no doubt it's underperformed its benchmark. MSVX has returned 11.53% a year since inception in October 2011, compared to the S&P 500 at 14.41% a year over the same time period, almost a 3% a year difference. But if you've followed my work over the years, you already know that those headline numbers can sometimes be deceiving. There's plenty of strategies out there with seemingly good rates of return that can do really well for a while, and then they can suffer disaster over longer periods of time. This is why I did that 5-part video series on risk-adjusted return metrics. You can check those out here. But in those videos, I showed why it's so important that we also look at metrics like the Ulcer Performance Index, maximum drawdown, correlation to the S&P 500, things like that. So let's get past the lower annual return number and check out some of those other stats. The first one there, maximum drawdown. This is a highly overlooked statistic, but one of the most important, because all investors have a level of risk tolerance. And it's really important not to breach that, because if it does, then they will pull the plug and abandon the strategy. These are end-of-month drawdowns, and this is a win for MSVX, with a maximum drawdown of minus 10.46% compared to the S&P 500 at minus 19.43%. The next one to focus on, which is my favorite risk-adjusted metric, is the Ulcer Performance Index. This measures the rate of return with respect to the magnitude and duration of drawdowns. And in my opinion, this is the most realistic measure of how it's actually going to feel in real time to invest in a strategy. With the Ulcer Performance Index, the higher the number, the better. So we can see here, MSVX is actually lower by a decent amount, at 3.11 compared to the S&P at 3.75. This shows that the rate of return to drawdown relationship of the S&P 500 is actually a little bit better than MSVX, and overall the S&P has been a better buy and hold investment long term. The last important metric here is correlation to the S&P 500. And I will say that although MSVX has clearly underperformed its benchmark performance-wise, it has at least demonstrated a low correlation to the S&P 500 at only 17%. This may mean that for some investors, depending on the goals you have for your portfolio, MSVX may still have some use as a portfolio diversifier. It's not that easy to find assets that perform reasonably well while still maintaining a low correlation to the S&P 500. So something like this may be useful for longer-term buy and hold investors as a smaller holding within a broader portfolio. One thing I was curious about, so I did run the numbers, is whether MSVX could be useful as a 60-40 balance fund when paired with US Treasuries. In black, we have 60% S&P 500 and 40% 20-year US Treasuries, the TLT. And then in blue, we have 60% MSVX paired with 40% TLT. So it's fairly close, they do more or less track each other, but that Sharpe ratio is quite a bit worse for the MSVX combo. So it seems it doesn't pair as well as the S&P 500 does with bonds. Just the dynamics of how those two move together are more well suited. So as a long-term buy and hold investment, the MSVX has underperformed its benchmark both on an absolute level and a risk-adjusted level. Like I showed, the Ulcer Performance Index, the Sharpe ratio, they are lower with MSVX. But for me as a tactical investor, I do always think it's important to differentiate under what market conditions that underperformance or outperformance comes from. These are all the annual return numbers for both MSVX and the S&P 500, and you can clearly see the pattern here. During the best 2 years for the SPY, 2013 and 2019, the MSVX underperformed by 7.75% and 33.93% respectively. And during the worst 2 years for the SPY, 2015 and 2018, MSVX outperformed by 12.84% and 6.93% respectively. So it's not an equal trade-off there, but the point is, MSVX is clearly designed to have its best performance years when the S&P 500 is struggling. Now that may be useful for some people because, like I said, it's not always easy to find. However, the problem comes back to what I originally said: this is a discretionary fund, so they may nail it in certain conditions, and they may miss the mark in others. And we can see this when viewing performance over the 3 largest market crashes in the last 9 years. These are the monthly results from August 2015 through May 2016, and that black line is the S&P 500. You can see it took the full 10 months for the SPY to get back to the break-even level from the August crash. Now, MSVX is designed to do a little better during those types of periods. And although performance-wise it was also just break-even over those 10 months, it did significantly reduce the drawdowns. This is the 4th quarter of 2018, another stock market crash, and it took the S&P 500 7 months to get back above the pre-crash level. As to MSVX, again, rate of return-wise, it didn't do any better. In fact, it was actually negative over those 7 months. But if drawdown reduction is the goal, then it did a better job navigating this period because the drawdown was much less. And finally, this is the most recent stock market crash in 2020. And we can't say the word on YouTube, but this is the 2020 health crisis. Through 6 months, the S&P 500 isn't quite back to break even yet. It's still down 3%. MSVX is about flat so far, but again, it did significantly reduce that drawdown. So during all 3 of those market crashes, MSVX was also either flat or down a little bit as well. So this is not a long volatility position where you could expect to make a big profit during a market crash. It's just about lower drawdowns and keeping that correlation to stocks lower, and it did achieve that during all 3 of those market periods. Now, one thing that is a little concerning and we'll have to keep an eye on is how it's performed in just the last few years. We can see here through June 2020, it's actually slightly lower than where it was at the end of December 2017, 2.5 years ago. We did have 3 major crashes in that time period: Volpocalypse in Feb 2018, the big Q4 2018 crash, and then the recent pandemic. Now, of course, it did reduce the drawdowns in all of those periods, but it didn't make any forward progress. We're going to have to wait and see how this develops, but we are seeing one of those periods where a major decoupling is happening. It had one of its best months ever in March 2020, which is a good sign, but it's given all of that back now. The S&P 500 is up 20.2% in just the last 3 months, yet the MSVX is down 10.5% in that same period. A 30% gap in just 3 months is no small amount, and again, I think this highlights the main point if you're planning to use this thing in your portfolio. Discretionary trading does come with it some inconsistencies. There's no doubt that they will have periods where they nail it and you'll be happy that you're holding it. And then there may be other periods where you're expecting it to do something, and it just doesn't. So for me personally, the only potential use I can see for MSVX in my own trading is using my volatility barometer, which is my own volatility index that I created, and perhaps holding MSVX as a tactical position only when the barometer is in its higher ranges. Essentially only holding it during those periods where it's designed to do a little better and avoiding all of the rest where it doesn't. So that's the LHA Market State Alpha Seeker ETF, the MSVX. Now the name doesn't quite do it because, as we've seen, it's not actually creating alpha over its benchmark. But what it is doing is reducing those drawdowns during the more unstable periods in the market. Think of this thing as a low correlation diversifier for a long-term buy and hold broad portfolio. So as always, you can visit my website, check out the Volatility Dashboard and all the volatility metrics. And if you do want to join the VTS community, there's always a free trial on the website so you can test drive it ahead of time. Thanks for watching. Thank you so much for watching the video. So don't forget to subscribe to the channel and go check out my website right here. There's tons of articles and videos on there, as well as a free trial to join the VTS investing community. What have you got to lose? Come see how I personally navigate these unruly markets. See you next time.